Hello, I'm Warren Buffett. Over the years, I've been asked a lot of questions about money, but one question seems to come up more than almost any other. Mr. Buffett, why don't you invest more in real estate? Now, I understand why people ask. Real estate has always had this glamorous reputation. Folks talk about buying properties, flipping houses, collecting rent checks, and getting rich without doing much work. It sounds good. It feels safe. And for many people, it's the first thing that comes to mind when they think about investing. But let me tell you the truth. For most people, and even for me, real estate is a lousy investment. It's not because it never works. It's not because nobody ever makes money in it. Plenty of people do. But the problem is that it doesn't work as well as people think, and it often distracts them from opportunities that are far better. So in this video, I'm going to share why I've avoided real estate for most of my career, why it doesn't fit into my approach to building wealth, and what you can do instead if you truly want to grow your money safely and consistently. My personal history with real estate. Let's start with a story. Back in the early days, when I was still a young man in Omaha, I did make a few real estate investments. One of the most notable was a farm I bought in the 1980s. The farm was in Nebraska, and I purchased it after the previous owner ran into financial trouble during a tough time in the agricultural markets. Now, the interesting thing about that farm was this. I knew nothing about farming. I didn't know how to drive a tractor. I didn't know how to plant or harvest corn. I couldn't tell you the first thing about soil science, but I knew how to read numbers. So what I did was simple. I looked at what the farm produced. I looked at how much it cost to operate. And I asked myself, will this farm keep producing corn and soybeans long after I'm gone? Will people still be eating? Will demand for food still be there? And the answer was yes. So I bought it. I still own it today. It produces a steady stream of cash, but here's the key point. I don't spend any time on it. I don't try to guess what farms are worth on a daily basis. I just let it produce. That investment worked because I treated the farm as a business, not a speculation. But here's what most people do with real estate. They speculate. They buy a property because they think the price will go up. They try to flip houses quickly. They stretch themselves with debt, betting that tomorrow will always be brighter than today, and often they get burned. That's one of the reasons I call real estate a lousy investment. It encourages speculation, not business thinking. Why real estate looks attractive but isn't. Real estate has a strong psychological pull. People like it because it's tangible. You can touch it, walk around in it, and brag to your friends about it. A stock certificate feels like just a piece of paper, or in today's world, a few numbers on a screen. A house or an office building feels real, but that tangibility can be a trap. Because it feels safe, people underestimate the risks. They borrow too much money to buy properties. They ignore the costs, repairs, taxes, vacancies, management headaches, and worst of all, they compare themselves to others. I can't tell you how many times people have told me, my cousin made a fortune flipping houses. Why shouldn't I do the same? Well, maybe their cousin did. But maybe they also got lucky with timing. Maybe they bought during a boom. Maybe they forgot to mention the properties they lost money on. The truth is, for every story you hear about someone striking it rich in real estate, there are 10 stories of people who struggled or failed. I prefer businesses where I don't have to rely on luck or timing, the opportunity cost. Here's something most people don't consider when they put money into real estate. Opportunity cost. Every dollar you invest somewhere is a dollar you can't invest somewhere else. If you take $10,000 and put it into a rental property, that's $10,000 you can't put into an index fund or into a company like Apple or Coca-Cola. So the question isn't just, will I make money with this property? The question is, will I make more money here than I could elsewhere? Over the long run, real estate has delivered average returns of maybe 6 to 8% per year. Not terrible. But compare that to the S&P 500, which has delivered closer to 10% per year over long periods. That difference adds up dramatically over time. $10,000 invested in the stock market at 10% grows to more than $170,000 in 50 years. At 7%, it's only about $75,000. That's a huge gap. And it's the opportunity cost of choosing real estate over stocks. That's why I often say, real estate is a lousy investment compared to businesses. Businesses innovate, they grow, they compound. Real estate just sits there collecting rent. Liquidity and flexibility. Another problem with real estate is liquidity. If you own a house and you suddenly need cash, what do? You can't sell one bedroom. You can't sell the kitchen. You have to sell the whole house or borrow against it, which brings more debt and risk. Stocks, on the other hand, give you incredible flexibility. You can sell as much or as little as you want, whenever you want. That liquidity is valuable. It gives you freedom. And it's not just about emergencies, it's also about opportunities. If the market suddenly drops and you see a wonderful business selling at half price, you can buy it instantly. But if all your money is tied up in real estate, you're stuck. You can't move fast. Flexibility is a huge advantage in investing, and real estate just doesn't offer it. Management headaches. Let me tell you another truth. Real estate requires management, and most people underestimate how much. Tenants don't pay rent, pipes burst, roofs leak, property taxes rise, local governments change zoning laws. These things all eat into your returns. Now, you could hire a property manager, but that costs money, too often 10% of your rent. Suddenly, your passive income isn't so passive anymore. I don't like businesses that keep me awake at night. I want businesses that earn money while I sleep. That's another reason I've avoided real estate. Speculation versus investing. Here's the biggest problem with real estate. For most people, it turns into speculation. Investing is about analyzing a business, buying it at a good price, and holding it for the long term. Speculation is about guessing what prices will do in the short term. Real estate tempts people to speculate because prices often move in cycles. There are booms when everyone's making money and busts when everyone's losing it. People think they can time it, but the truth is, they can't. I've often said the stock market is designed to transfer money from the active to the patient. The same is true for real estate. Those who chase quick profits usually end up handing their money to those who wait patiently. But didn't you buy a house? Now, I know what some of you are thinking. But Warren, don't you own a house yourself? Yes, I do. In fact, I still live in the same house I bought in Omaha in 1958 for about $31,000. It's a good house, comfortable, filled with memories. But here's the key point. I didn't buy it as an investment. I bought it as a home. If you buy a house to live in, to raise your family, to create stability, that's perfectly fine. In fact, it can be one of the best purchases you'll ever make for your happiness. But don't confuse a home with an investment. One gives you shelter. The other is meant to grow your wealth. And the truth is, your home usually doesn't make you rich. It gives you a place to live, and maybe it appreciates a little over time. But when you factor in all the costs, maintenance, taxes, insurance, the returns aren't nearly as good as people imagine. A better way to think about wealth. So if real estate is a lousy investment, what should you do instead? The answer is simple. Buy productive assets. Assets that generate cash, grow over time, and compound. Stocks are one example. They represent ownership in businesses that innovate, adapt, and expand. Over decades, they've consistently outperformed real estate. Bonds can also have a place, though today with low interest rates, they don't offer much. And most importantly, invest in yourself. Learn, read, develop skills. That's the highest return investment you'll ever make. If you've been finding this helpful and you'd like to hear more lessons from my years of investing, consider liking this video and subscribing. It doesn't cost you anything, and it helps us keep sharing timeless ideas that can truly change your financial life. The math of compounding. One of the most powerful forces in the universe is compound interest. Albert Einstein supposedly called it the eighth wonder of the world. I've always said that my wealth came not from intelligence, but from three things: living in America, having good genes, and compound interest. Now, compounding works best when you combine high returns with long-time horizons. Stocks give you both. Over the past century, the U.S. stock market has averaged about 10% per year. That means money doubles roughly every 7 years. Hold for 30 or 40 years, and the growth is extraordinary. Real estate, on the other hand, typically returns 6 to 8%. That may not sound like a huge difference, but over decades, it's massive. Let's say you invest $100,000. At 10% for 40 years, you end up with about $100,000, $4.5 million. At 7% for 40 years, you end up with only $1.5 million. That's a $3 million difference, all because of a few percentage points. This is why I'd rather own a piece of Coca-Cola, which keeps selling billions of drinks every year, than a rental house that just collects the same rent month after month. Real estate's hidden costs. Another issue is the hidden costs in real estate. On paper, you might think, my house went up from $200,000 to $400,000. I doubled my money. But did you? Over those years, you paid property taxes. You fixed the roof. You replaced the furnace. You repainted, landscaped, and insured it. Maybe you paid a mortgage too. Those expenses eat away at your gains. With stocks, you don't have to replace the roof at Apple. You don't have to mow the lawn at Google. The company reinvests in itself. You just sit back and let compounding work. Real estate disguises its returns by ignoring costs. Stocks don't. That's another reason why real estate often disappoints. One of the reasons real estate stays popular is psychology. People want to feel safe. A house feels safe. You can touch it. You can live in it. It doesn't disappear like a stock certificate might. But feeling safe and being safe are two different things. I've seen people lose their shirts in real estate because they confused tangibility with safety. The market doesn't care how solid your bricks are. If demand drops, prices fall. True safety comes from understanding your investment, buying at a sensible price, and holding for the long term. That's why I prefer businesses. Why I avoid commercial real estate. Now, sometimes people ask, Warren, what about commercial real estate? Office buildings, shopping centers, surely those are good investments. Well, let's think about it. What's happening in the world today? Retail is shifting online. Offices are changing because of remote work. Shopping centers and office towers aren't as reliable as they used to be. Meanwhile, companies like Amazon and Microsoft keep growing. Which one do you think has a brighter future, the office building Amazon rents, or Amazon itself? I'll take the company every time. Exceptions to the rule. Now, I'm not saying nobody should ever touch real estate. There are exceptions. If you truly understand your local market, if you buy at a good price, if you're willing to hold for decades, and if you treat it like a business rather than a speculation, yes, you can make money. But most people don't do that. Most people chase trends. They buy when prices are high because their neighbors are making money, and they panic when prices fall. That's not investing. That's gambling. And I don't gamble with my future. So what should you do instead of chasing real estate? Number one, invest in broad-based index funds. They give you ownership of thousands of businesses at once. They're simple, low cost, and proven. Number two, if you want to pick individual stocks, focus on companies with durable competitive advantages, good management, and sensible prices. That's what I've done all my life. Number three, invest in yourself. Your skills, your education, your ability to think clearly. Those pay off better than any piece of land ever will. Let me be clear. I didn't avoid real estate because I thought it was evil. I avoided it because it didn't offer me the same opportunities as businesses. I could study businesses. I could understand their economics. I could project their future. And I could buy them at attractive prices. Real estate, by comparison, offered fewer opportunities, more headaches, and lower returns. That's why Berkshire Hathaway owns dozens of wonderful companies, but very little real estate. So what does this mean for you? If you're just starting out, resist the temptation to buy real estate because everyone else is doing it. Instead, ask yourself, what's my goal? If my goal is to build wealth, shouldn't I choose the investment that compounds the fastest with the least risk and the most flexibility? For most people, that's not real estate. That's businesses through stocks or index funds. I'll end with this story. Years ago, I had a chance to invest in all sorts of things. Gold, real estate, collectibles, you name it. But I kept coming back to the same principle. Does this asset produce something of value? A farm produces crops. A business produces goods and services. Real estate sometimes produces rent, but often people buy it just because they think it will go up in price. That's speculation, not investment. Don't speculate with your future. Invest in things that produce. So, is real estate always bad? But is it usually worse than people think? Yes. For most investors, real estate is a lousy choice compared to owning productive businesses. It ties up your money, it comes with hidden costs, it tempts you to speculate, and it underperforms compounding businesses over time. If you want to build real wealth, stick to the basics.